Welcome back to another GT Homes exclusive. One of the questions we often hear is, what is the first-time home buyer incentive? Great question. The first-time home buyer incentive is an interest-free loan that will reduce your monthly mortgage payments, making home ownership more affordable. This program was first launched by the federal government in September of 2019 with the goal to help young middle-class buyers get into the real estate market. This program is a shared equity mortgage that allows you to borrow 5% or 10% of the purchase price of a home. When you're ready to sell the home or after the 25-year window, you would pay back the same percentage of the home's value to the government. This means that if you received a 5% incentive when you purchased a home, you would repay 5% of the home's fair market value at time of repayment. You will need to repay the incentive after 25 years or when the property is sold, whichever comes first. However, you can also repay the incentive in full anytime before without a prepayment penalty. Here's how it works. A shared equity mortgage means that the government shares in the upside and downside of the property's value. Let's say, for example, you're interested in purchasing a home for $500,000 and you receive a 10% incentive of the home purchase price, which is $50,000. A couple of years later, you decide to sell your home and the value increases by $150,000. Your repayment will be 10% of that current value, which is $65,000. The amount you will receive for this incentive depends on the type of home you're purchasing. A new construction home, including a pre-construction condo unit, will receive 5% or 10% of the purchase price, while a resale or existing home will receive 5% of the purchase price. When the incentive program first launched, your total qualifying annual income couldn't exceed $120,000, and the mortgage amount you could borrow couldn't exceed 4 times your annual income. However, a new program update recently became available in spring that states that first-time home buyers purchasing a home in Toronto and some parts of the GTA will receive an increased qualifying annual income of $150,000 and an increased total borrowing amount of 4.5 times your annual income. In order to be eligible for this incentive, you must be a Canadian citizen, permanent resident, or non-permanent resident authorized to work in Canada. Your total annual income cannot exceed $120,000 or $150,000 if you're purchasing the home in Toronto and parts of the GTA. Your total borrowing amount cannot exceed 4 times your qualifying income or 4.5 times if you're purchasing the home in Toronto and parts of the GTA. You or your partner are a first-time home buyer. Your intent is to occupy the home and not use it as an investment property. You meet the minimum down payment requirements with traditional funds. This means that you're paying 5% of the down payment from a savings account, registered retirement savings plan, or you received a financial gift from a relative or an immediate family member. All first-time home buyers must come up with their own down payment of at least 5% of the purchase price. The incentive can only be applied to a mortgage greater than 80% of the property's value. This means that if you're planning to put 20% on the down payment, then there's no need to apply. Applying for this incentive is simple. Once you determine that you're eligible, you've been pre-approved for a mortgage, and found the home you're looking for, you can then apply by filling out 2 application forms. After you have completed the application forms, you can give them to your mortgage lender who will submit the application for you. So now that we understand the basics of the first-time home buyer incentive, let's look at a scenario of how it could be applied. Let's say that you're a first-time home buyer that's interested in purchasing a pre-construction condo and you have an annual qualifying income of $110,000. With this incentive, you can purchase a home for a maximum purchase price of $465,000. If you're contributing at least 5% of the down payment, which is approximately $25,000, the first-time home buyer incentive will provide you up to 10%, which equals to $46,500. Now your total down payment will be $71,500. Since you're putting less than a 20% down payment, you'll still need to pay mortgage insurance. In this example, your insurance premium will be approximately $11,018, which is $6,000 less than what you've paid if you've only put down 5%. So your total mortgage amount will be $465,000 for the purchase price, minus $71,500 for the down payment, plus $11,018 for the mortgage insurance, which equals to $404,518, and this is your total mortgage amount. With all of these calculations in place, your monthly mortgage payments could be $2,041, depending on your mortgage's interest rate. This is a $267.83 less than what you would have paid if you only put in 5% for the down payment. In total, you could save approximately over $3,000 in the first year and over $33,000 in 25 years. The only requirement with this incentive is that you repay the loan after 25 years or when you sell the house, whichever comes first. And you can repay the loan at any time within the 25 years with no penalty. When it's time to repay the incentive, you will be repaying the total amount borrowed for the home's current value. If the home increases or decreases in value, then you're paying 5% or 10% of the current value. When you're ready to repay your incentive, all you have to do is get an appraisal done to determine the fair market value of the home and submit the paperwork. That's it. The first-time home buyer incentive is a simple process, and it's beneficial to any first-time home buyer that wants to buy their own home and get into the real estate market. For more information about the first-time home buyer incentive, check out our website. Stay tuned for our next video where we talk about the land transfer tax. This has been another GT Homes exclusive. Remember to subscribe and to visit us at gtahomes.com.